Good morning, everyone. Let's see what we got cooking today. Happy Wednesday, December 20th. Hope you're all doing well. We got this Streamlabs thing here on the screen. We'll just move it out of the way so we can take a look at these equities, right? Let me just do one of these. I'm back in Canada. I'm back in Toronto for the holiday season, see my parents and stuff. I lost my luggage, so I'm wearing this sweater from like 2015. Some of my old clothing, I gotta get my clothes. So it's interesting starting the day, not even early, but off the morning, getting into the market open. But let's see what we have in terms of the markets today, the news. Yesterday, we moved into new all-time highs on the futures. On the S&P 500, not back adjusted, keep that in mind. The last print of an all-time high on the futures was 48.08. Yesterday, we printed into that low 20 on the overnight session or whatever it was. And if we look at the actual indices, right, the cash indices, we had the Dow Jones last week printed a new all-time high. The NASDAQ, right, the NASDAQ 100 printed an all-time high. The S&P, right, very, very close to an all-time high. The SPX, right, S&P 500, if we look at the actual cash index or the index itself rather than the futures, didn't quite get there, but we're very, very close. If we take a look at, for example, let's open up like TradingView here. Looking at corn. Hold on here. Let's look at the SPX. This wants to load. Come on. Yeah. Let's see. Oh my god. Why is this so freaking slow? Anyway, so as this loads, we saw that the market overnight kind of pulled back in the S&P. We saw the futures kind of pulling back. Excuse me. Wow. But the actual current session, right, the morning session that opens up could be very, very different. We've been on a multi-day, multi-week run to the upside in the equities realistically, and we could continue, right? We could continue this Santa rally that just completely runs to the upside, because as it stands right now, we don't necessarily have a lack of buying, and we don't have positioning to the downside. Everyone's looking extremely long, and that downside, right, when volatility actually spikes, is most likely going to happen midway through January rather than right now, right before this holiday season or at the beginning of January. A lot of people are getting very bearish as this thing continues to rally aggressively, but I don't necessarily think that's the tone to take. I think that it's very difficult to call a top at an all-time high. It's very difficult to trade all-time highs as well, because people just want to continuously short this, short this, short this. The best thing to do, excuse me, if you're on the bear side and you're looking for this thing to capitulate realistically, is going to be some kind of change in structure, right? Let this thing run, let this thing move to the upside, but the change in structure happens from the acceptance into a distribution lower, and it could take a very long time for that to happen. It could take weeks, months. I don't necessarily think months, but it could be something that happens very, very distant in the future, while a lot of people are just continuously selling as this thing rallies, getting punched in the head. So right now, I think that there is still more upside. I don't think that the full blast of euphoria has yet hit the markets. We're getting there, and most likely we're going to see some kind of consolidation at these highs rather than just a drop to the downside. So there's been a pretty decent shift in the expectations for monetary policy since late October, sending equities on a 7-week rally, right? A very broad 7-week rally. The most recent boost came from last week's FOMC meeting when Jerome Powell formally lowered inflation forecast for 2024 and telegraphed that there could be 3 rate cuts in the new year, which is higher than originally expected. The question is, when will it become appropriate to begin dialing back the amount of policy restraint in place? Is clearly a discussion topic out there in the world, and also of discussion for us. So he declared I would say a general expectation that is that this will be a topic for us looking ahead. Realistically, everyone's expecting the first rate cut to come in March 2024. I think that it gets pushed back a little later than that. I think that markets still have a decent room to the upside to go. And a lot of people are going to be pissed off about this rally. I think that pullbacks are small, mainly consolidative, before that upside momentum continues. So the biggest contributors to yesterday's rally in the S&P and generally for the year have been our usual suspects, currently dubbed the Magnificent Seven, as we've been talking about. This includes Google, Amazon, Apple, Meta, Microsoft, Nvidia and Tesla combined up 75% in 2023, while the remaining 493 names in the S&P are up about 12%, right, resulting in a net 25% gain year to date for the index as a whole. So the bull market has been given big returns to many investors, and just as seen, Wall Street's fear gauge, known as the VIX, is at its lowest level since the start of the COVID-19 pandemic, where a lot of people are looking at this thinking that volatility is excessively cheap, and they're loading up on that, expecting a massive spike in volatility. But I think that that could be the case in weeks to come rather than more immediately. Trying to time this top, like I've said before, is going to be a very, very difficult thing to do. But I think we're short-term, very overextended. I, for one, am not trying to call tops, just opening up some hedges that have months and months of time just in case something like that happens. Keep that in mind. So the pivot from higher for longer to rate cuts, pretty bullish for the stock market, as could quote-unquote cancel a recession, say many analysts across the board. And we could see that stocks can go much higher next year. There are some people that look at the S&P and think that is due for a very large decline. And as you know, banks, analysts, right, they have different views, and they change very drastically as the market movement changes. Remember, just in September, when we were having that larger turn down, a lot of banks repositioned their targets for year end, right? Probably 1,000 points lower than they are right now, right? So in just a few months, right, there's a lot of changes in sentiment. So you got to keep that in mind. Realistically, the way that this is shaping out, is that we do have continued upside. We do have the momentum to continue higher, the market being higher for longer with consolidative periods until we reach about mid-January. And then we get those deciding moments from the Fed as we come into the end of the first quarter, second quarter. I think there's still euphoria in the markets, but we're going to have more volatility in the coming next 2 years, with 10% pullbacks being a little more common than we've seen compared to the last year per se. So keeping that in mind, you want to stay diligent, you want to stay nimble, you want to stay liquid. You don't want to just constantly try to fade this first and foremost. But there could be a little more increased volatility in the coming year as we've rocketed very aggressively. So we have something else, right? We have FedEx. That reported earnings down about 11% here pre-market. On both, it missed estimates on both lines in its Q2 earnings report and cutting its revenue guidance amid ongoing demand weakness. The company reported adjusted earnings of $3.99 per share and revenue of $22.2 billion, down 2.6% year over year. The decline in revenue was led by FedEx's largest unit, Express, hurt by lower volumes and fuel surcharges. With regard to Q3 expectations, we anticipate our typical seasonality, which implies a lighter quarter sequentially for earnings. CFO John Dietrich said on the earnings call. The disappointing outlook weighed on FedEx's rivals, sending UPS lower as well, about 3%. So as we enter midweek, today's Wednesday, let's take a look at what we could get cooking in these markets, because we've rallied quite a bit. Markets are pulling down here pre-market. We could be in a space where we could start to see some kind of more sideways movement as we have 3 full days, I should say, until the last full week of the year is over. So we've seen small consolidations for a nice increase to the upside. You have to look at the 4808 area on the S&P 500 futures. 4808 marks the prior all-time high on the futures It's a distribution low where they bought into yesterday. It's an area that I would watch very, very carefully. If we start slipping, I think the last chance for the buyers to come in is that 47.90 area. Otherwise, we start entering into a distribution lower, and more likely than not, we just rotate sideways and could see that 47.60. So I don't necessarily want to just be on constant sell, sell, sell. I want to play these large levels, as well as understanding that we're in a pretty just buy the dip momentum move here into the end of the year. But we have to understand if we start accepting distributions lower, for example, we start entering under 48.08, excuse me, there could be some kind of downside momentum that shifts us another 20 handles to the downside, for example, and then we can start a consolidative period. You have to understand where these distributions sit and how they affect directionality. So under the 08s, I'm going to be very cautious as more downside could come until we start hitting some areas of higher volume, which include that high 80, low 90 on the S&P 500 futures. So with that being said, let's pull